Okay, so it's only 2 minutes late. I have so much information to give to you, so I was hoping I'd get back on right away. Thank you, John and Kate, and thanks for everybody for taking the time to spend the next hour with me. Barry Bergman is available, the BCI Managing Director. Oops, I forgot to put his name on my screen here. Sorry, Barry. To answer your questions in the chat box, please take advantage of that. Barry can answer dozens and dozens of questions, and I may or may not have a couple of minutes left at the end. My topic: selling cash secured puts. And we're going to talk about option basics plus 4 advanced practical applications. So the basic selling of cash secured puts plus 4 additional practical applications. You will find in my presentation this morning strategies that are just perfect for this challenging market environment. So get pen and paper in hand because we're going to be giving you a lot of quality information regarding these strategies. Now, you're going to be seeing a lot of real life examples. I want you to take them for educational purposes only because at the time that I executed these trades, they were appropriate for this type of investing, but may or may not be appropriate today. Let me give you a course overview, what I hope to accomplish in the next hour. We're going to just go over option basics as it relates to selling puts. We're going to talk about the 3 essential skills necessary to achieve the highest levels of success. And then we're going to get into 4 applications. Traditional selling of cash secured puts. We're going to talk about the put call put or PCP strategy, which is sometimes referred to as the wheel strategy outside of the BCI community. We're going to talk to you about how to buy a stock at a discount instead of setting a limit order when we want to buy a stock, but we don't want to pay full price. And finally, we're going to talk about an ultra low risk put delta strategy. And that would be particularly good in this challenging environment, along with that PCP strategy. I want you to take a look specifically at the slide that I titled Downside Protection on Steroids and see how that would have application in today's market environment. Now, at the very end, you know that we always present a package, and I'm very proud of the package we're presenting in the last couple of slides. The BCI is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. And so we'll talk about that in the last couple of slides. It's a 25% discounted package. But I've thrown in a few extra slides today, which I normally don't do, about a new product that we're developing and have been working on now for the last year plus with Barry that we're beta testing, and it'll be available. Interested in this because it's the only one of its kind anywhere to my knowledge. So that's at the very end. Let's get started with some information now. Option basics. What is an option? Well, it's a contract. It's a made up thing that gives the buyer of that option the right but not the obligation to either buy or sell 100 shares of stock. So one option contract is the equivalent of 100 shares at a fixed price, known as the strike price, at a specified date, known as the expiration date. Most options expire 4 p.m. Eastern Time on Friday. Monthlies expire on the 3rd Friday of the calendar month. So a contract monthly expiration is not the same as a calendar month. Call option gives the holder or buyer of the option the right but not the obligation to purchase 100 shares of stock at the strike price by the expiration date. So if we sell a call option, we are selling some unknown person the right to buy our shares at a price that we determine, the strike, by a date that we determine, the expiration date. And we will be using call options in conjunction with that put call put strategy. Now, put option, which is the focus of today's webinar, gives the holder of that option the right but not the obligation to sell 100 shares of stock. So if we sell a put option, we are agreeing to purchase shares at the strike price by the expiration date. Now, I want to talk to you about the strike price as it relates to the price of the underlying security. Now, at the money is the easiest one to understand. It's where the value of the stock is the very same as the strike price of the put option. So an example would be is we sell a $50 put option, agreeing to purchase the shares at 50 on a stock that's actually trading at 50. Now, very closely related to that is the near the money strike, which means that the stock price is slightly different. It's off by a few pennies. So if the stock is trading at 50.10 and we sell a $50 put option, that strike is said to be near the money. Now, an in the money put option is where the strike price, the price we're agreeing to purchase the shares for, is actually higher than the current market value. An example would be to sell a $50 put on a stock trading at 48. Now, even though we're not really going to be using in the money puts in today's presentation, the reason one might do that is because the put option is going to compensate us for the loss of $2 plus a little bit more. But in the BCI community, we favor out of the money cash secured puts. An example of that would be if the price of a stock is trading at 75, we sell a 72.50 put agreeing to purchase those shares at 72.50. That strike is said to be out of the money. So for puts, out of the money is lower than current market value. And in the BCI methodology, that, folks, is the focus of our selling cash secured put strategies. Okay, let's talk about traditional selling of cash secured puts. This is the strategy for puts that I use mostly, but I have to tell you, I use all of the ones that I'm going to be discussing today. Here's a preview example. BCI is trading at 75. We sell that out of the money 72.50 put for $2. That's a typical premium we would get if the stock has a greater implied volatility. The premium would be greater. A lower implied volatility, the premium would be a little bit less, with a 1-month expiration. So the broker is going to want us to deposit the cash into our account to secure that put. If the put buyer decides to exercise that put and sell their shares to us. Now the broker is going to say, okay, Alan is agreeing to buy 100 shares of BCI at 72.50. That's $7,250. But the broker will also allow us to apply that $2 put premium, $200 per contract, towards the amount of cash that we need to secure to sell that put. So the actual amount that we have to put in is $7,050. Now, we generate $200 for every 100 shares of obligation. Let's continue this preview example now. That premium is ours to keep no matter what. So let's start with that. Whether the value of that put goes higher or lower, that $200 is ours. It won't change. But now we have a contractual obligation to buy 100 shares per contract of BCI at 72.50. If the put buyer chooses to exercise that option. So what is our initial profit? 200 divided by 70.50, and that's a 2.8% 1-month return, which annualizes out to 34%, just to give you some perspective on the trade. Now, that doesn't mean we're going to end up with that, but that's our starting point. Now, there are two major outcomes that can happen, assuming no exit strategies. And those of you who are familiar with the BCI community and the information we provide, you know that there's no such thing as ignoring exit strategies, but for purposes of setting our initial structuring of the trade, we're going to leave out exit strategies. Talk about that more later on. So the first example, if the price of BCI remains higher than 72.50, the strike, remember it started out at 75, the option buyer is not going to exercise that option and sell their shares to us at 72.50 if the stock price is trading higher at market. It won't happen. Option expires worthless. We have our 2.8% 1-month return. The cash that was used to secure that put is now freed up to then secure another put for the next contract cycle. The second possible major outcome, again, ignoring exit strategy opportunities, is if the price of BCI does in fact drop below that 72.50 strike and we take no action and the option is exercised, the shares are sold to us at the agreed upon strike of 72.50. The cash that we previously deposited is used to make that purchase. Now, at this point in time, we have to take off our option seller's cap and put on our share owner's cap. What do? There are three paths we could take. We could sell the stock. Well, our break even was 70.50. If we sell the stock and the price is higher than 70.50, we have a realized capital gain. If it's lower than 70.50, we have a realized capital loss. Tax issues if we're trading in non-sheltered accounts. Now, we can hold the stock for the long term, which is a strategy I will be discussing. Or we could write a covered call. The shares are put to us. We now own the shares. And we can then write a covered call to continue the cash generating process. And this is a strategy I will also be discussing. So let's summarize what selling cash secured puts is all about. We're selling put options, which is secured because the cash is first deposited into our brokerage account and available if the shares are assigned, if the option is exercised and shares are assigned or put to us. But we are getting paid to undertake a contractual obligation to buy the holder shares at the strike price by the expiration date. That, folks, is what selling cash secured puts is all about. Now, I'm going to ask you nicely not to invest even 1 penny of your hard-earned money until you have mastered these 3 required skills. Not 2 of them, but all 3 of them. First of all, what stock or exchange-traded fund are we going to use? Don't pick the one that gives you the highest returns. That's a terrible mistake. I'll talk about that in a second. What option are we going to select? What strike price? What expiration date? And finally, exit strategies, which pretty much are beyond the scope of this webinar, but I will touch upon it a little bit. Now, in the BCI methodology, I just want to give you a brief overview of how we select our securities for short-term option selling. Fundamental analysis is step 1. Why? Because the institutional investors, now I'm talking about mutual funds, hedge funds, banks, insurance companies, love stocks that are fundamentally sound, sales and earnings growth. I'm very big on Investors Business Daily because they are statistically based and statistics generally don't lie. So I use as my database several IBD screens, the IBD 50, Big Cap 20, CanSlim, but we also have our own database that we've identified over the past 15 years as potential option selling securities. So our screening is not like a typical screening. It's geared specifically for short-term option selling. We then run these through the IBD Smart Select ratings, which analyzes stocks and the industries that the stocks are in from both fundamental and technical perspectives and require them to have the highest ratings in each of the 6 categories. Then we also look at mean analyst ratings, so when you take a consensus of what the analysts are ranking each security, they are ranked 1 to 5, 1 being the best. We only take securities ranked 3 or lower. We also look at on-balance volume. Volume on up days, subtract volume on down days, and you will get a trend either going up, down, or sideways. Certainly an uptrend is a bullish signal. Now, those of you who don't want to become members of BCI and get our reports, there are a lot of free screening services out there. Finviz.com is one of them. But once again, keep in mind, these are geared just for buying and selling stocks. We are geared for short-term option selling. We also screen our stocks from common sense perspectives. We avoid earnings reports. We have a list of banned stocks that you should never, ever use for short-term option selling because of risky monthly same-store sales, retail sales reports, and the airline stocks, which have monthly capacity reports. Those are all banned. We also have minimum trading volume requirements of 250,000 shares per day. We want to make sure that our stocks and our options have adequate liquidity. We want to make sure that our stocks and industries are well diversified. No one stock or industry should represent more than 20% of our total portfolio. Much less is preferable. And we also want to allocate a similar amount of cash per position. And in my material, I teach how to do that. It's not that complicated. The third prong of our screening is from a technical perspective, and we use 4 parameters. I'll just name them for you and show you a chart of what a bullish chart will look like. So we use exponential moving averages, which give greater weight to the more recent prices. That identifies trend. We use the MACD histogram. I'll show you what that looks like in a second. It's a fancy name for something very easy to identify. And that gives us trend and momentum. The stochastic oscillator is also a momentum indicator. And we look at volume for confirmation and perhaps for negative volume divergence. So here is a bullish chart for Etsy. I'll mention that pretty soon. Number 1 are the exponential moving averages. So we want to see the shorter term blue above the longer term red. You could tell which line is higher. You could tell if it's going up, down, or sideways. That's a bullish trend. The MACD histogram are these blue bars over here. We'd like to see them above 0, which they are. The stochastic oscillator, we also like to see an uptrend. There are certain parameters that give it an extremely bullish or bearish indicator, but right now we have a bullish indicator with the stochastic oscillator. And we want to make sure that volume isn't drying out, which it is not. So if we looked at this chart within 3 seconds after you've looked at a few dozen of them, you would say, bullish chart, I'm going to take a bullish position on my trades. This is a screenshot showing just a snippet of our 18-page stock report that we provide to our members on the weekends. Actually, it's a 9-page report. The second half is in larger font for those that are visually challenged. But this blue bar on the top goes through the fundamental, technical, and common sense screens that I just alluded to. And then the stocks below are the ones that are eligible. If you see them in these yellow or gold cells, that tells us that there are earnings reports coming out, and you have to wait for the report to pass. We also give our members a view of all the eligible stocks for each week in that particular contract month, plus the last week of the previous month. So you can kind of follow along. Like CF, for example, you see has been very bullish the last 3 weeks in this particular screenshot here. And when they're in bold, that means they had the most bullish of technicals. Now, let's talk for a second about options. An option chain is just simply a list of prices for a particular security. And every broker has it. Whatever broker you're using has this information, folks. But there are free sites that also give it to you, like the cboe.com. I'll be showing you some screenshots taken from that site. And you just go to the options link after entering the ticker symbol, and you will actually get the option chain. So this is an example of Etsy, which was trading at 129.62 when I made this screenshot. And remember, we're going to look at out of the money puts, strikes lower than current market value. So I just highlighted 2 of them for you, 115 and 120 strike. This is a monthly screenshot here. And you could see the bid price on the options was 630 and 795. Later on, I'm going to show you how to negotiate these prices with the market makers. And so what we do is we feed them into the spreadsheet, and you can see you enter the data here. The trade was entered on 2/18 and expires on 3/18. The entry price for the stock I told you was 129.62. The 2 put strikes out of the money and the put premiums. And the spreadsheet this is part of the spreadsheet I'm going to talk to you about later on, this new product we're developing, gives you the return on your option, initial return. You could see there were 580 and 710 respectively for a 29-day trade. That annualized out to these very large numbers because Etsy has some high volatility at this time. And what if the price of the stock drops below the strike? How much of a purchase discount from the original price of 129 are we purchasing Etsy? And you could see 14% and 16%. The spreadsheet will also give us our total portfolio position as we enter all our trades for that particular contract cycle. Now, we will have an opportunity also to make our trade adjustments. One of the unique features of the spreadsheet I'll be talking about later. You can see there are 10 different options in terms of exit strategy opportunities, and we can adjust our trades accordingly. So that's the traditional put selling strategy. Now let's go to application number 2, which is the PCP put call put, or some folks refer to it as the wheel strategy. I feel that PCP describes the strategy better. It's more intuitive, and basically that is what we are doing. So this is a graphic representation of the strategy. If we started on the top left, we're selling an out of the money cash secured put. If it's exercised, that means if the price drops from current market value to below that out of the money put, which was lower than current market value, and we take no action, the put will be exercised and we'll buy a stock at the discounted price. Now, we own the shares, put on our share owners caps, we write a covered call. Could be in the money for defensive purposes, out of the money if we're more aggressive. If it's exercised, then we sold our shares and we have all this cash. What do we do with it? We use it then to secure another put. Here's a preview example. We buy 100 shares of company XYZ at 48. And this is a preview, by the way, for covered call writing, since we're introducing that. And we then sell the out of the money 50 call. Out of the money for calls is higher than current market value. We paid a premium of $1.50. 150 for the 100 shares. And that represents a 3.1% 1-month return. That annualizes out to 37%. That doesn't mean that's where we end up. We can end up higher or lower. The first possible outcome, if the stock price is still lower than 50, started out at 48, our shares are not going to be purchased. Why would the call buyer buy our shares for 50 if they're trading at market at a lower price? So, the call expires worthless. We keep the 3.1% 1-month profit. We still own the shares, and now we're free to sell another call option. The other possible major outcome without exit strategies is if the price of the stock does in fact move higher than 50 and we take no action, even by a penny. Well, what's going to happen is our shares will be sold the Saturday after expiration Friday at 50. That means we make an additional, over and above the 150 premium, 200 on the sale of the stock per contract. That's a $350 total profit for the month realized, 7.3% 1-month return. Now, folks, there are disadvantages to these strategies. If the price of the stock drops below our break-even price point, we could start to lose money, and that's why it's essential that you master the third required skill of position management. So, the 3 words in the term covered call writing. Covered means we buy the stock first. We know our cost basis, $48 in this preview example. Call is the type of option we are selling. We're selling some unknown person the right but not the obligation to buy our shares from us at the strike price by the expiration date, which we determined in advance of structuring this trade. Writing means we're initiating a sell to open order. With selling to open is the same thing as writing a covered call. Now, I like to use this real-life example for the PCP strategy because it gives me the opportunity to show you how to negotiate with the market makers. So you could see here that at the time I made this screenshot, T-Mobile US trading on the NASDAQ TMUS was trading at 86.09. So if we were to sell an out-of-the-money cash secured put, the strike would be lower than 86.09. I selected for demonstration purposes the 82.50 strike, which had a bid price of $291. You'll notice there's a very wide spread between the bid and the ask. the ask being 610. I'm going to be using 291 for the calculations, but I just want you to know that you're going to get a better price than that. But let me show you how to do that. Now, some of the brokers will help you along with this, but if you want to be sure, then you have to know how to leverage the show or fill rule. And the show or fill rule requires market makers to do one of two things. Either to give us the limit order price that we put in if we improve the market, which simply means a price between the bid and the ask, or if it chooses not to do that, then to publish it. So I'll show you how that works in a second here. Any order between the bid and the ask will improve the market. Now, the bid-ask spread for TMUS was 291 to 610. Step one, find the midpoint, which is known as the mark, 450 in this case. Place a sell to open limit order somewhere between 295 and 445. I always favor the market maker a little bit. Let's say we put it in at $4, which is $1.09 higher than the bid price of 291. So we put in a limit order, sell to open this put, the 8250 put at $4. Now, if it's accepted, that means we generated an additional $109 per contract. Go out on a Saturday night, buy you and your wife dinner, or you and your husband dinner. Now, if it's rejected, or you and your significant other, I'm going to stop there. Okay, if rejected, the new spread becomes $291 to $4. So you could see that the market makers who like wide spreads might decide, well, let me just give Alan his $4 and get rid of him because he's only putting in for a few contracts. And that's how that works. Now, one final thing regarding this show or fill rule. If your brokerage platform shows an all or none or AON box, do not check it, because if you do, the market maker is not beholden to that show or fill rule. Okay, let's get back to T-Mobile. Trading at 86.09, we sell the 82.50 out of the money put for 291. Here are the stats. The return on our option is 3.66%, which based on a 39-day trade annualizes out to 34%. So that's one thing that can happen. The other thing that can happen is that if the price of the stock does in fact drop below the strike price, we will purchase T-Mobile at the break-even price of $79.59, which represents a 7.55% discount from the price when we entered the put trade. And this is the information that will be generated by the spreadsheet. Now, once we own the shares at a break-even or cost basis price of $79.59, we can then write a covered call. Could be out of the money, let's say $82.50, or it could be in the money, lower than current market value, $77.50. I went to the option chain, and these were the premiums, $2.30 and $4.25 for the in the money. So here's how it broke down. The two strikes generated a similar time value return for a 33-day trade, 2.9 and 2.8. You can see they both annualized out based on that 33-day trade of 30+%. Now, on the out of the money covered call, we had an opportunity to generate an additional 3.7 if T-Mobile went from current market value up to the out of the money strike. For the in the money strike, we had downside protection of 2.6%, which meant the price of T-Mobile can drop by 2.6%, and we would still will have generated our time value profit of 2.8% for that 33-day trade. Now, I want you to look at that red arrow, folks. 75.34 is the break-even price point for the in the money strike, which is a 5.2% downside protection to break even. Okay? I want you to look at that because I'm going to show you this screenshot now, downside protection on steroids. In the put end of the PCP trade, we had a purchase discount price of 7.55%. That was if the put was exercised. Now, we had a 5.2% downside protection to the break-even price point of 75.34. Well, I know I'm throwing a lot of numbers at you here, but that's what I do. But let me summarize it for you this way. If T-Mobile dropped by 10% in that 2-month time frame, our break even was 12.75%. We still would have made money in that 2-month time frame. So this is a fantastic opportunity to make money and mitigate risk in market environments like we're currently experiencing right now. PCP strategy is a wonderful strategy in challenging, volatile, and bearish market conditions. So just to summarize this, we set our goal. You have to know, what are you looking to generate? For me, it's 2 to 4% a month for my initial time value returns. And we sell out of the money cash secured puts, generating this kind of return. Might be a little lower if you're more conservative. It might be a little higher if you're more aggressive. We manage with exit strategies if those opportunities arise. If unexercised, sell another cash secured put. If it's exercised, we write a covered call, in the money or out of the money. We manage those with exit strategies, if indicated. If the covered call is unexercised, we write another covered call, and if it is, we sell a cash secured put. Once again, folks, here is a graphic representation of that strategy. 2 down and 2 to go, folks, and these are a little shorter. Application number 3, buying a stock at a discount. So a lot of us have a stock that we really love. We don't want to pay full price. We say to our broker, hey, broker, I want to purchase 100 shares of this stock if it drops from 80 to 73. Here's $7,300 in my cash account. See if it drops. Well, if it doesn't, you don't own the stock at your target price. And that $7,300 has been sitting in your cash account, twiddling its thumbs, doing absolutely nothing for us. Or we could write an out-of-the-money cash secured put. Here's a more recent example with Micron, which on 2/21 was trading at 90.10. Let's say we wanted to buy this stock at 83, right? I'm just picking a number here. We love it, but you know what? If it drops to 83, I'll buy it. So we know there's no upcoming earnings report because the contracts expire on 3/18. And we set a limit order to buy at 83. Well, maybe we'll get it, maybe we won't. Maybe the cash will do what we want it to do, maybe it won't. Or, better idea, sell a cash secured put that has a break even in the galaxy of $83. Here's the option chain. Remember, Micron is trading at 90.15. We sell the 85 out of the money put for 255. What's our break even? Let's see. It's about 82.45. That's in the neighborhood of 83. Let's do it. You could see huge open interest, 18,000 contracts. Put it into the spreadsheet, and we have a 90.15, the 85 strike at 255. So here are the two things that can happen. We could purchase Micron at 82.45 if the option is exercised, which is an 8.5% discount from starting market value. Or if we don't buy it and the price of Micron remains above the 85 strike, we will have generated a 25-day return of 3.09%, which annualizes out to 45%. Those are the two things that can happen. That's it. We get the stock at our target price, or we generate a return. Now, what's the risk? Well, Micron can take a nosedive, right? It could take a nosedive, and we can end up buying the stock at a price higher than current market value. Remember, we screened the heck out of the stock before we used it as an underlying, number one, and number two, we haven't utilized our exit strategy arsenal. Let's move on now to the fourth and final of these applications before I show you our new trading tool, get into the BCI package, and if there's any time left, I know Barry has been answering a lot of your questions. There's nobody that does it better than Barry, but if there are any questions at the end, I will be happy to take them for you. So application number 4 is using an ultra low risk, high probability put delta strategy. So what we're going to do is we're going to use weekly puts, but you can use monthlies too. The reason I'm using weeklies is because we're taking such a defensive stance. We're accepting much lower returns than you saw for traditional put selling. And in order to annualize that out to a higher number, weeklies will oftentimes do the trick for that. So I'm using weeklies, but keep in mind you can also use monthlies. The key here is to use deltas of 10 or less. So here's an overview of the strategy. We're going to use the very same stock selection screening that we talked about before, implementing fundamental analysis, technical analysis, common sense principles. That doesn't change. Now, as far as the option selection is concerned, we're going to go deep out of the money with weekly puts. Now, that means way lower than current market value and with deltas of 10 or less. Now, for put deltas, you will always see a minus sign before the number, and that minus sign is there because put value is inversely related to stock value. So if stock value goes up, put value goes down, and vice versa. Now, we're going to use weeklies, but as I said before, you could use monthlies too. We're going to target an annualized return of 10 to 20%. Now, that's on the low side if we were doing traditional put selling, but I mean, compare that to what's going on today with CDs and money markets and treasuries. I mean, that's pretty significant and substantial. And I'm sure just about everybody in this room would be very happy with these kind of returns for 2022. Now, delta it's an option Greek, and it can be defined in three ways. The way that most are familiar with it is the amount that an option price will change for every $1 change in share price. Again, put deltas are inversely related to stock price. So that's one. The second definition is that portfolio managers use it. Delta is the equivalent number of shares represented by the option position. So a call option with a delta of 60, if you buy a call option, that's the equivalent of 60 shares. A put option, which has a delta of minus 60 per contract, means you're short 60 shares. And what they do, these portfolio managers, they add up the pluses and minuses. They try to come as close to zero as possible, thereby minimizing overall market risk. That's really not for us. Now, the way we're going to use it, though, is the percentage likelihood that upon expiration, an option will expire in the money or with intrinsic value. So it's a close approximation of probability of exercise. So if it has a delta of 10, that means there's a 10% chance that the option will be exercised. So when we sell a cash secured put, most of the time we don't want that put to be exercised. We just want the money. We don't want it to be exercised. So that means there's a 10% or better chance that it will not be exercised. So it's a high probability trade. Once again, we're going to go back to Etsy with this bullish price chart over here. At the time I made this screenshot, it was trading at 169.97. We're going to go deep out of the money. And we're going to look at delta. Now, this is taken from the CBOE site. Every broker will give you delta stats. You just have to find out where they are. But if you want to use a free site to get that, this is cboe.com is a very good one. And you can see that the 152.50 strike deep out of the money compared to the current market value of 169.97 had a delta of 8 and a bid price of 44 cents. Could we have negotiated that a little bit higher? Probably. Maybe putting in at 46 or 47 cents. But we're going to use 44. So how does it work? Well, it passes our requirement for a delta of 10 or less. We're going to use the 44-cent bid price. Well, how much cash is required? The put strike minus the put premium of 152.06 per share. What is our return on our option? 44 divided by 152.06, 0.29% per week. And that annualizes out to 15% within our 10 to 20% target range. And because it had a delta of 8, that gives us approximately a 92% probability of success. So here's another different put trade I had on Etsy, where I sold the 165 put, which had a delta of 9 to 38 cents. So that was the premium I used, 9. I actually executed this trade. And how much cash was required? Well, the 165 strike minus 38, 164.62. And that resulted in a 1 week return of 0.28%, 14.7% annualized. Now, look what happened. This is all within a 1 week, Monday to Friday. Look at that red circled area. What the heck happened here? Well, on Wednesday of that week, IBD comes out and names Etsy as its stock of the year for 2021. Thursday, the next day, Motley Fool comes out and names Etsy as one of its stocks of the year. So boom, the price goes up Wednesday. Boom, the price goes up Thursday. What happens when price goes up? The put value goes down, which means I can close that put at a way lower price than I generated when I first sold it. And I could still retain that 10 delta requirement. So I did that. I closed the put for, let me go back. I think I don't remember if I gave you the return of 14.7. Yeah, I think I did. Okay, so that's where we started out. Now, I was able to close that 165 put for 10 cents and sell the 187.50 strike I rolled up for 48 cents, still retaining that 10 delta or less requirement. So now my credits were 38 minus 10 plus 48, 76 cents now. I have to secure that put with the 187 minus the premiums, 187.02. That annualizes out to 21.1. So I went from 14.7 to 21.1. Was I done? No, because the next day it went to the moon again. I was able to close that 187.50 at a penny. That's right, a penny, $1 per contract, and sell the 205 put I rolled up for 23 cents, maintaining my 10 delta or less requirement. 38 minus 10 plus 48 minus a penny plus 23. Now it was 98 cents. And that gave me a 25% annualized return. So 14.7, 21.1, up to 25. Now I knew when I rolled up to the 205 strike that on Friday there could be a ton of profit taking. And there was a possibility that my shares might be put to me at that 205 strike. I didn't care. I loved the stock. And lo and behold, it did. It dropped slightly below the 205 strike. So the shares were put to me. I could have closed the put trade and not taken possession, but I decided to take possession. What did I do? Well, I had a choice. I could have kept the stock in my long-term buy and hold portfolio. I could have written the covered call, or I could have sold the stock. I decided to wait to see what happened Monday morning when it opened up. Well, guess what? It opened up at 217. I made an additional 25.29. Now, I didn't know it was going to open up that much higher, but I had a plan in place whether it did or it didn't, because I was going to use this security for the next contract cycle, no matter what, somewhere, because that's how bullish I was on this stock at that point in time. Well, let's summarize. You can generate a significant annualized return by employing this ultra-conservative put selling strategy. Delta will allow us to create a low-risk, high annualized return strategy. 10 to 20% target is not unreasonable for an annualized return using this strategy. Now, once again, there is no strategy that's a panacea. There's always risk in every strategy that we use. If we're seeking to generate higher than a risk-free return, there's always risk. Our job is to mitigate that risk, and don't let anybody tell you differently. There is always going to be risk. So this is a low risk, not a no risk strategy. So you must be prepared with our exit strategy arsenal before entering a trade. Before I show you this one-of-a-kind tool and talk to you for a moment about our BCI package, let me just review what we just talked about. We went through the option basics As it relates to puts, we talked about the 3 required skills essential for short-term option selling. We used 4 practical applications: traditional, the PCP, put call put strategy. We talked about buying a stock at a discount instead of using limit orders, a great strategy, and our low risk put delta strategy. By the way, just as an aside, part of the information in our package is another low risk put or covered call strategy where implied volatility is used instead of delta. Another great low risk defensive approach where you can have a very well protected trade and still get a significant annualized return. Now, for over a year now, Barry and I and the BCI team have been working on a new tool, the BCI Trade Management Calculator, part of the BCI Trade Management System. I believe it's the only one of its kind anywhere in the world. As a matter of fact, I called up contacts I have at the Options Industry Council and I asked them if they knew of such a tool, and they told me they did not. It allows us to enter our covered call writing or put selling trades, get initial calculations, get total portfolio initial calculations, then adjust our trade using one of 10 exit strategies and getting our individual stock and option adjusted results, our total trade results, and our total portfolio results. We have been beta testing this for over a year, and now we have a team of 6 outside the BCI team beta testing this. It will be available in about a month. So I just want to show you a couple of quick screenshots of what's involved. There are 2 main spreadsheets to this calculator. The top part is dedicated to covered call writing, the lower half selling cash secured puts. At the very bottom, in each of these 2 main sections, there are 5 tabs. There's a trade management calculator, the meat and potatoes of this, a user guide, I believe it's about 28 pages, until you get familiar with the spreadsheet. There's a What Now tab and an Unwind Now tab for covered call writing worksheets. You don't have to use them, but they're there available. And a Rolling In tab, which is probably a term that many of you never heard. We created it because it is an exit strategy that was never talked about before, but I'll be talking about it a lot moving forward. But that is also available as a worksheet in this calculator. Now, the sections within each of these spreadsheets, your opening trade entries, you saw a little bit of that in the webinar, the opening trade initial calculations, as well as the total portfolio initial calculations. Then there is an exit strategy trade adjustment section. There's 10 exit strategy opportunities for each of these strategies. And it will give you the calculations and final combined trade results, along with total portfolio combined trade results. Now, each section will also have a capital adjustment area. So if you're using more than one exit strategy in the same contract cycle, you'll be able to account for that since we're using the same investment for more than one strategy. Here's what it looks like when you're opening your trades. Here's what it looks like when you get your initial trade calculations. On the right side, you'll also see the exit strategy price points we include in the spreadsheet in those yellow fields over there. The total portfolio initial calculations per week or month, depending on which your preference is. Then there's the adjustment section. You could see here for covered call writing, you have 10 choices, and then you put in the information, and then in the white cells, the spreadsheet will give you your results per trade, combined per trade, and total portfolio results for that particular contract cycle. Here's the section for capital adjustments at the bottom. Now, when you print this out, this was a little challenging, but we figured it out, and I should say Barry figured it out. When you print it out, it's going to print out in 4 sections, so you can actually put it in a binder and save it. The first section is for covered call writing. You'll get initial trade entries, initial calculations, and total portfolio initial calculations. Page 1. Page 2, exit strategy entries, calculations, and final combined trade results, and the capital adjustment section, along with total portfolio combined trade results. That's page 2. And then pages 3 and 4 print out for cash secured puts. So all that, and then you can put it in a binder. You could review your trades, learn from them, and archive them, and you'll have your entire year's trades archived using this spreadsheet. Now, I'm going to talk to you for the remaining couple of minutes that I have about our BCI package, best and most comprehensive investment package ever offered by the blue-collar investor. It contains 18 components. Our annual premium membership, which is 13 months of membership. Show you what that is in a second. 6 of our online video courses with downloadable workbooks, 6 calculators and spreadsheets, 5 of our best-selling books in ebook format. You're going to save $335, which is a 25% discount for our total adjusted price of $997. You could see on the screenshot the link to click on when you go to www.thebluecollarinvestor.com and you click on BCI package. Now, the annual premium membership consists of 4 reports that we provide to our members for option selling, 2 weekly reports, one on stocks, one on ETFs, a monthly blue chip report on the Dow 30 stocks, and a quarterly report for dividend capture stocks. We also have over 200 educational videos, and we add a new one every single month, so we have continuous training videos, plus a few dozen files and other trading resources. Now, once you get this package, you will be grandfathered in to the renewal rate of $695.40. So in 13 months, to continue your premium membership, you will be billed $695.40 if you decide to continue. The other 17 items is a one-time lifetime charge and lifetime access. So it's only for the membership where you get the reports and the training videos that you will have to renew after 13 months. But you will never see a rate hike once you are grandfathered into that price. The other 17 products is a one-time lifetime charge. So on the screenshot on the left, you see the video courses. They come with downloadable workbooks. So it's covered call writing and selling cash secured puts, plus their related strategies. You could see them on the left side of your screenshot. And we have calculators for each of those strategies, plus a trade planner, which defines your trading goals and contingency exit plans, and a stock repair calculator for those of us that have portfolios dedicated to just buying and selling stock. You have a losing stock. You want to lower the break even without adding additional cash to your trade. We have developed a calculator for that. We have on Amazon.com the best-selling books on covered call writing and selling cash secured puts. They are included in this package of 5 books, plus a book on stock investing for students, which is a financial literacy book, not options, that's being used now in 4 universities here in the United States as part of their financial literacy program. So those are included. And as part of the premium membership, again, we have over 200 training videos in our Ask Alan library of videos, which are available only to premium members, and our in-depth Blue Hour webinars. We add 1 or 2 training videos each month. Once again, to access this package, go to our website, www.thebluecollarinvestor.com, and click on that link. Now, all of you who sign up for this package by tomorrow, today or tomorrow, when the trade calculator, the trade management calculator is ready, we will be sending you a link to purchase it along with a $100 discount coupon. We estimate the sales price is going to be $279 for that trade management calculator, and we'll be sending those of you who purchase the BCI package, when it's ready in about a month, the link to purchase it along with that $100 discount coupon. So that's in addition to the discounted price of the BCI package.
Right, Alan, that was fantastic. time to set up the next speaker, and Alan has kindly offered us 3 prizes, which we're going to hand out right now. Alan, love working with you and look forward to seeing you in the next summit in 3 months.
Thanks, John, and thanks to everyone who attended. Take care, everybody.